In the previous lesson, we covered buying single options, which is used as a directional play on a stock. In this lesson, we're going to now move into selling single options. I have been trading options since 2000 and have worked alongside some incredible traders over the years, and it's a pretty standard opinion within the industry that selling options is how to achieve long-term success. This strategy involves selling options with the hopes of buying those options back at a later date for a lesser price, or to let them expire totally worthless, keeping all the money. Educated investors who are looking for high returns with reasonable risk that seek to put the odds of success in their favor will flock to this strategy. Selling, also known as shorting options, is a strategy that many high net worth investors consider crucial. But it's a strategy that is available to anyone and can be implemented given the right approach and strategy. Let's recall quickly what an option is. A call option gives the buyer the right to purchase stock at a predetermined price and within a specified time period. The seller of a call option is obligated to fulfill the rights of the buyer if that buyer chooses to exercise those rights. As we can see, there are two sides to this trade. We can either buy the option, or we can take a short position and sell the option. If we buy the option, we're hoping to then sell the option later at a higher price. Everyone knows the logic of buying low and selling high. Selling an option is no different, except traders are performing the buy and sell trades in reverse. They open with a sell at a price they hope is the high, and then buy the trade back at a later date for a lower price. This concept of selling something we don't own might seem confusing to new traders, but it too is something that is used by many businesses outside of the investment world every day. Companies sell items that they don't currently own or have in their inventory. The last time I purchased a pair of jeans, the company that I was doing business with didn't have my size, but they told me they could get them and ship them to me in about a month. I agreed, and the store sold me the jeans, even though they did not own the jeans. This is the same concept. The store was confident they could sell me the jeans for one price, then later find the jeans for a lower price, buy them, and deliver them to me for a profit. This is similar to selling options. The goal is to sell the options at one price, then later buy them back at a lower price. However, when selling options, there's an absolute guarantee that we will be able to deliver, so it's not without risk. If we sell a call option, we're guaranteeing the delivery of the stock at the agreed-upon price to the buyer of the option. In the event the stock surges and the option buyer decides to exercise his right to buy the stock at the agreed strike price, we must deliver the stock. If we do not own the stock, we must go out and buy the stock at the current market rate and then sell the stock to the option buyer at the strike price. We don't want that. So if we sell a call option, we're betting that the stock is going to stay below the strike price. As long as the stock does not trade above the strike price before the expiration date, we will be able to keep the premium. Just like we can sell a call option, we can sell a put option. This is the same concept, only with a put option, we're betting that the stock stays above the strike price. If we're wrong and the stock traded below the strike price, then the put buyer will force us to buy the stock at the agreed-upon strike price. We don't want that either. So, if we sell an out-of-the-money call option, we're going to win if the stock trades down a lot, trades down a little, trades sideways, or even up a little. The only way we lose is if the stock trades up a lot. So, this is a bearish to neutral strategy. If we sell an out-of-the-money put option, we're going to win if the stock trades up a lot, up a little, sideways, or even down a little. The only way we lose is if the stock trades down a lot. This is a bullish to neutral strategy. This is why the selling option is so powerful. We don't have to get the direction exactly right. Let's look at an example. First, we have Bob, who is an active daily stock trader. Bob thinks stock XYZ, which is currently trading at $50, is going to trade up over the next month and buys 100 shares. Next, we have Matt, who is also an active investor, but who trades options. Matt sees the same thing as Bob and makes the same prediction that XYZ is going to trade up. Only Matt sells a 30-day to expiration 40 strike price put and collects a premium of $100. Both of these investors are hoping that XYZ goes up, but Matt has a much higher probability of success. If the stock trades sideways over the next month, still trading at $50, Bob will not make any money, while the option Matt sold finished out of the money and expired worthless, allowing him to keep his $100 premium. It's true that if the stock does trade up, Bob could make a lot more than Matt, but Bob did have to put up a lot of capital to do so. How about we consider another scenario? What if both investors are wrong and XYZ trades down to $45 in 30 days? Bob would end up losing $500, while the option Matt sold would still end up expiring worthless, resulting in a nice profit of $100. As you can see, Matt has a huge advantage to profit because he is betting on where the stock won't go, versus Bob, who's betting on where the stock will go. Bob will only win if the stock does what he's hoping it will do, and actually loses money with every penny the stock trades down. Matt will make his full investment just as long as the stock does not trade below the short put strike of 40. This means it can trade up, sideways, or even down a little, and all scenarios work out great for our option trader Matt. I hope you're now starting to see how powerful selling options and collecting a premium can be. But this strategy does not come without risk. Let's assume the stock traded down to $37. Here, Matt would be forced to buy the stock at 40, even though it's trading at 37. This means the option has $3 of intrinsic value at expiration, and because each option contract controls 100 shares, Matt would take a loss of $300 minus the $100 premium he received, so his net loss would be $200. This is clearly bad, but when compared to our stock buyer Bob, Matt is still coming out better. Bob, who owned 100 shares of stock, lost $13 per share for a total loss of $1,300. Ouch! XYZ trading down to $37 is only one scenario, and there's always the risk of the stock trading down even further. This means there's no limit to how much money Matt can lose, at least down to zero for selling puts. This is why options scare a lot of people. Matt is betting that the stock is going to stay above 40, but theoretically it could trade down to zero, and if it did, Matt would have to buy the stock for $40 100 times for a loss of $4,000, minus the $100 premium he received for a total loss of $3,900. Risking $3,900 in exchange for only a $100 reward seems like a bad investment to most new traders. There's a huge substantial risk and limited profit potential. Anyone can see that. But is that fair? What about our stock trader Bob, who actually purchased 100 shares of XYZ for a total of $5,000? Buying stock is also not without its risk, because if the stock does go to zero, Bob would lose his total investment of $5,000. Of course, Bob could have made a lot more if the stock did trade up, but it should be understood that buying stock is also not without its risk. Moving back to our short option position, as we can see, risking a huge amount of capital in exchange for limited profits scares off a lot of investors. So why is selling options the preferred method for most educated option traders? It's pretty simple. In exchange for taking on a large amount of risk and capping potential profits, option sellers are getting a large probability of success. I would like to remind you that there's always going to be a direct correlation between potential profits and probability of success. Traders who consistently beat the market understand this. In the last lesson, we talked about the buying option strategy, and we discussed when we buy options, we risk very little capital and have unlimited profit potential. Sounds pretty good, right? Selling options has the exact opposite strategy. We have to risk a lot of capital, and we have limited profit potential. That does not sound so good. Except when you factor in the third and most important element, the probability of success. The fact is, we could just go to Vegas, put a $100 bet on any number on the roulette wheel, and we would have limited risk. Only $100, and we would have huge profit potential of $3,500, just like buying an option. And there is always the chance that we could win. But the reason why most people don't do this is there's a very small probability of success. The casino loves it when people take this strategy, because they know the probability is on their side. They dazzle guests with the lights and the possibility of winning big. But in the end, the casino knows they're going to win because they have the probability on their side. Buying versus selling options is the exact same philosophy. You need to ask yourself, do you want to have the power of probability in your hands, much like a casino? Or do you want to gamble and hope you get lucky, like the player? One of these strategies is proven to work and used by educated money managers and high net worth individuals, and the other is used by people hoping to get lucky and hit it big. The fact is, selling options is not risky when performed intelligently, and when you execute many high probability trades that pay a little, in the end, that turns out to be a lot. When there's a loss, it can be adjusted so it stays small, and then easily absorbed by all the profits from the many winning trades. With that said, don't go out and sell a bunch of options either, as there is a lot more learning we need to do in order to keep ourselves safe. If you're feeling a little confused, don't worry. That's normal for everyone, and with time and experience, it will all start to make sense. All right, everyone, that's it for today. In the next lesson, we're actually going to go through the process of selling an option live, so you can see firsthand how selling options work.